So good morning and good afternoon and good evening to all the participants based on the geography where you're located. Once again, we would like to extend a very warm welcome to our knowledge sharing session. This is fifth in the series of webinars which we have been doing, and our plan is to extend this over a period of 6 months, wherein experts from across the globe would be coming over and sharing some of the best practices in the area of credit risk, market risk, operational risk, liquidity risk, and other associated areas. So my name is Suresh Iyer. I'm working for JMR Infotech as Executive Vice President. Just to give a brief intro on JMR, JMR was established way back in 2007 and has its operations in more than 30 countries, headquartered in UAE, and has successfully delivered more than 200 projects across the globe. It has a strong risk and compliance practice. And today, Mr. Nag, can you go to the next slide, please? Today, I have immense pleasure to introduce very important speakers. Of them, Dr. Nag, can you move to
Yeah,
next
I'm
slide?
trying this next one. Yeah.
So let me introduce Mr. Kannan, who comes with over 4 decades of industry experience. He was the former chairman and managing director, and comes with immense hands-on focus towards the risk and compliance area. He is on the board of several leading companies as well, and also he is an advisor in the risk management area. I also take this opportunity to introduce another well-known personality in the risk and compliance space, Dr. Ashok Kumar Nag, or AK Nag. He was earlier Chief General Manager at Reserve Bank of India, and he has architected a product for catering to the operational risk requirements of banks. So he comes with over 4 decades of experience, and currently he is driving the risk management practice at 63 Moons, one of the listed companies on the Indian stock market. Next slide, please. So what we intend to do is to cover a brief introduction to operational risk, then what are the typical challenges we see during the course of implementing ops risk framework, what are the various approaches as per the Basel requirements. This entire webinar series, since it has a focus towards the credit risk aspect and the Basel aspects, we thought it's prudent to bring in how some of the approaches of ops risk are very important from the Basel implementation perspective as well. So today, Dr. Nag would be covering that as well. So what we believe is banks should adopt a good risk and compliance policy and process that gives good opportunity to create value, and value creates stakeholders' wealth. Next slide, please. So today, if we look at the entire risk and compliance area, what we believe is in the past, this important area, operational risk, was seen more from a cost-benefit angle. Banks typically used to spend time in capturing and reporting risks, and it was more seen as a error or problems or issues banks face during the course of its operations. And the emphasis was on how to manage that. But today, operational risk has gained a lot of attention from the top managements of the bank. And not surprisingly, even the Basel Committee has devoted quite a bit of time and attention on covering the operational risk aspect. Today, banks look at operational risk as one of the very important area which may even impact its very own survival itself. That is the seriousness with which banks are looking at operational risk. So today, operational risk is no longer the responsibility of just the operational risk department or the risk management department. In fact, it is the board's agenda to oversee and ensure the entire operational risk framework is properly implemented and aligned to the overall business vision of the bank. Next slide, please. So let me pass on this session to Mr. Kannan. Over to you, Mr. Kannan.
Thank you, Mr. Suresha. Once again, greetings to all my banker friends from across the globe. I am representing Basel practitioners over here. The mission at Basel practitioners is to be a convenience facilitator for bankers. This webinar series is actually intended towards that. We are here today to look at operational risk. Again, let me take the help of BIS. Operational risk has been defined by the Basel Committee as the risk of loss resulting from number one, inadequate or failed internal processes. Number two, the people. Number three, the systems. Number four, from external events. This definition includes legal risk, but excludes strategic and reputational risk. Remember, three of the four are internal and specific to each organization. For this very reason, the operational risk solution and management becomes specific to each institution and is not generic, because people and culture are different in each bank and financial institution. Systems and procedures followed are also different. Now, operational risk involves breakdown in internal controls, personnel, and corporate governance, leading to error, fraud, or performance failure, compromise on the interest of the bank, resulting in financial loss. Banks and financial institutions have struggled to control operational risk, and major banks have suffered over billions of dollars in operational risk losses since 2011. The key to effective operational risk management is training the people to anticipate what could go wrong, especially when a business unit is about to do something new. Regulators regularly review a bank's vulnerability to operational risk. Yes, as they do with financial risk, the regulators require banks to maintain capital buffers to help them manage an operational risk episode should it occur. But when an operational risk event does occur, it can have profound, long-lasting spillover effects. Now, with digitalization and straight-through processing, banks can reduce or eliminate human intervention in many transactions, thus containing the risk of employee error or fraud. Now, while automating processes once done by hand can reduce human operational risk, but at the same time, it can, if not monitored properly, magnify cyber security risk. In addition, banks can take their zeal for cost cutting and efficiency a little far, to the point where it can actually undermine the quality of operational risk management efforts. Now, against all these challenges, risk practitioners are seeking to develop better tools, frameworks, and talent. Now, leading institutions are now discarding the traditional rear view mirror approach, basically administered by numerous qualitative controls. For effective operational risk management suitable to the new environment, institutions are refocusing the front line on business resiliency and critical vulnerabilities, adopting data-driven risk measurement and shifting detection tools from subjective control assessment to real-time monitoring is the way forward. Hence, after the webinar on data governance, it is our pleasure to bring in the operational risk expert to talk to you. Dr. A.K. Nag was a senior executive of the Reserve Bank of India, who is the regulator for the banks and financial institutions in India. Post his retirement, he is the head of risk management practice at 63 Moons and is overseeing development of operational risk solutions. He is here to talk to you on the practical aspect of operational risk management. Like in the earlier webinars, our request would be to take the cue from Dr. Nag, and if you have any specific queries with respect to the situations or hurdles which you face in your institution, please put it in the chat box. We have a Q&A session running after the delivery of lecture by Dr. Nag. We will take up all the issues and we will try to address. And if you have any other queries after this also, feel free to contact us at our website, baselpractitioners.com. Now over to Dr. Nag. Dr. Nag.
Thank you, Mr. Kannan, and thank you, Mr. Suresha, for giving me this invite to share my little experience in this area with the bankers across the world. And as a bankers, if all of you know that how important is operational risk as one of the risk category. If you see this, that operational risk, if you look at the challenges, is that how do I implement, and let me go to my one slide. Okay, fine. See, Mr. Kannan has already defined operational risk. Now, when the operational risk we are discussing, because it has come to the radar of the regulators, when it came to the radar of regulators. If you look at the risk management practices across the world, which is now under the guidance of the BCBS Committee of Basel, is that there is an evolution of the risk management practices from the regulatory point of view. Initially, when 1988, Basel I was introduced and 92 it was implemented, it was only started with the credit risk and very, very broad kind of credit risk without a lot of kind of differentiation between various types of borrowers. Then, because that time they saw that credit risk is the most important risk faced by a bank may become insolvent, and if there's a lot of default by the borrower, and you should have adequate capital to absorb loss because of the default. But afterwards, it was clear that even banks can become insolvent if your investment book has a lot of kind of suddenly a lot of kind of erosion of their values, and you may lose that also your solvency kind of requirement. Then what happened? There was no discussion of the operational risk initially. In 1995, one of the 17 oldest merchant bank in the UK and one of the most stable bank, Barings banks, actually was bankrupted by one single person's kind of a rogue trading. And that was Nick Nishenson. In fact, he wrote a book, Rogue Trader, made money out of that when he was convicted because of this. So it was clear that you may not have any default of your borrowers. You may not have any big loss in your investment portfolio, but you still can become insolvent because of your failure of that, what Mr. Kannan has told, or definition of this, either process or the people. So the operational risk is defined loss resulting from inadequate or failed internal processes, people and systems, or from external events also. So question is that it was quite clear for the regulatory perspective that unless you sensitize the banks of the importance of your operational risk, and also you have to have capital for absorbing operational risk, then only it becomes much more sensitive to the banks. So operational risk must be brought in the regulatory perspective, and there must be capital to absorb loss from operational risk events. So here is a speech from a governor of the Reserve Bank. Recent history provides us with ample evidence that operational risk can be significant. Large financial institutions have operational risk losses from breakdowns in operation control. And in fact, all these things, that is the internal control is always there in every commercial organizations, but to have the operation risk, a specific kind of a risk management kind of activities within a commercial banks became much more important after these kind of events happened. In fact, one of the biggest event which has happened in India recently, what we call the Nirav Modi case, where you look at this, the entire failure of this bank. Of course, bank did not become insolvent, but it lost $1.1 billion because of this kind of a failure of the process. That is not a failure of a default at all. So what is peculiar of the operational risk? One of the major problem of the operational risk kind of a implementation in the bank. If a bank wants to implement market risk, it has got a specific kind of instruments. Either you have evaluate risk or you calculate durations, duration-based approach where market risk capital can be computed. All these are very standard kind of a computational process, standard kind of techniques are available, and you can calculate, for example, if you have a credit risk, you have been doing the credit scoring for long, you know what is the credit worthiness of the borrowers. You can calculate the probability of default quite to a certain level of accuracy, and these are very kind of a standardized, like Altman Z squared, which is a credit scoring which is running for long period. So market risk, credit risk has become a kind of a very standardized kind of a process to be implemented in a bank. Everybody knows how to do it to a large extent. But when it comes to operational risk, it is always a bank specific. Every bank must have its own operational risk framework. That is what Basel committee says. That will be, approved by at the board level, and the senior management must be responsible for that framework. The operational risk framework is a bank specific. What is your process? Even if you suppose you have a loan giving process, everybody knows the loan giving process, there is a certain kind of a uniformity across the banks, but every bank has certain kind of specific kind of a innovations or specific kind of process, maybe jurisdiction wise, or even the bank within a jurisdiction have a bank wise. So operational risk is a very important part of your bank's management responsibility, because you do not have recourse to a very standardized approach of managing operational risk, which is you can just kind of import and install and you can make it operational immediately. You can have any software, like we are providing software, but that is a smaller, more kind of a easier thing to do. Most important for operational risk from a banker point of view is to have your own operational risk framework well documented, well understood within the bank. Let us go to these things like operational risk, that what is your source of operational risk? It is people, it is process, system, external. Let me tell you that all this, what is the bifurcations or the segregations we are doing, the source, they are not necessarily independent of each other. A people risk and process risk both can happen in one kind of a big loss event. For examples, when the Nick Leeson happened case, of course, he was doing illegal certain kind of trading to camouflage or to his losses he is making on certain kind of a thing. But at the same time, there's a failure of the process. What was the failure? Failure of the process is that there is no segregations between middle office and front office. So the persons at the Singapore, which is the Nick Leeson's office of the BRD, he was actually reporting to your head office as well as he was the trader. Similarly, if you look at the Nirav Modi case, where is that failure? What was the failure? What is the Nirav Modi case? Nirav Modi case is that a particular, company, a diamond merchant, okay? So he was actually having a letter of undertaking issued by Punjab National Bank in India. And that letter of undertaking is letter of undertaking is nothing but a bank guarantee. So using this bank guarantee, the particular person was drawing credit in the Hong Kong to have import certain kind of things, exports. Now, this letter of undertaking was given to these persons it is also not only external fraud, it is an internal people failure, people fraud. Why? Because one of the major kind of a, process in, it is a process that you must have your give letter of undertaking to your customer, existing customer. This person was not existing customer. If you are not existing customer, you have to have 100% collateral taken for any issue of letter of guarantee. And second thing is the letter of guarantee is a contingent liability. So it is not appearing in the balance sheets, not in the proprietor's account. So it is very easy to hide this. Now, when letter of undertaking is given, the message is going through SWIFT. SWIFT messages are possible to get and what you call the informations, all information messages which are flowing to the SWIFT from this bank to the another bank in Hong Kong. These are all recorded in the SWIFT. All are the part of the database, and there is a possibility of generating every day reconciliation that what have been messages external, incoming and outgoing. This is a report is to be created. This was not done. So this was a failure of the process people also. And this was not, there was no KRI indicator of this. What was the KRI indicator? You should have highlighted here. This KRI indicator, what should have been highlighted is that the person who was carrying out this kind of internal fraud with the help of the external fraud is that he was there for only almost 7 or 8 years it is continuing. So this a person's not transferred from one desk to another for 5-6 years should have been brought in a kind of a KRI, which should have been there. And this again was when it was detected, when he went retired and left and then detected. This is a problem. So it is not only people's failure, it was an external fraud, it was internal fraud, it was a process failure also. So whenever this kind of opportunities even happens, all these events you're talking about, people failure, process failure, system failure, even external fraud, they need not be independent of each other. They may be confounding will be there, and we have to know that which is more important. But it is very important for us to understand that. So people failure is like unauthorized trading, like a fraud, like insider dealing. Process breach of mandate, like a mandate is that you have to take 100% collateral. That breach of mandate means that the internal people who was committing fraud is breaching this mandate. And this is not being correct. Incorrect transaction, mispricings, mis-selling of these things is a kind of thing. System failure could be there, external failure could be there, that could be catastrophic kind of thing. And that is what the operational risk failure. So once you understand that sources of operational risk, okay, then you have to see that operational risk process management maturity. What does it mean? That we can start, because most of the banks have started taking operation risk seriously and creating a kind of framework within the bank and implementing it consistently is only very new phenomenon. Even Societe Generale, if you remember, Societe Generale, the third, largest French bank and on the largest 13th or 14th largest bank in the world, one person's only, I think Cavill, his name, and he's 4.3 billion euro was lost because of the failure. So what is the process failure was happened? Despite, if you remember the Societe Generale people, they're all called saint because they are dealing, the investor bank and bankers are called saint because they're absolutely coming from the most top-notch, the University of the France. They are doing, and they are using the most sophisticated kind of a mathematical kind of all kind of a process and the investment kind of a guidelines. So despite that, this person could make a kind of a trading which leads to this biggest amount of the failure. So point is that you have to see the maturity of these things. That means you may have the other guys dealing process updating as a very sophisticated, but do you have operational risk management maturity is to understood. So what is that stage one traditional banking? We have an internal audit, internal control, reliance on the, your quality of people and the culture. This is, we always talk about culture. Then stage two is the awareness and data aggregations. What is the policy of operational risk? What is the policies, HR policy? What are the various kind of policies are there? It is then operational risk infrastructure, definitions, process, early indicator, and event loss data. Event loss data we'll come to later on. What are the kind of characteristics of the event loss data you should have? How do you process the event loss data? That is a part of our this notice of opinion. We'll come to later. So first thing is a stage 2 is awareness, and are you aggregating data? Point is that losses are going on happening across the bank's various branches. See, India, people have maybe State Bank of India, 13,000 branches, but there are many branches across the world, banks having branches. So it is important for us to the various vertical, various business lines. Are we able to take a holistic view, a 360 view of the entire operational risk event? The problem is that we are only asked to report sometimes a loss data, but potential what we call near miss event, whether it is being properly kind of reported. I remember that when we were discussing the operational risk with the general manager of Indian Bank, how to implement, we were discussing with him. And he told that what makes you believe that at the really those branch level where the operations are happening, they will actually report an operational risk event to the head office. What way is it possible to have operational risk event automated way can it generate? I think it's not possible. Operational risk event has to be understood, has to be classified. What is the source of the risk is there at the certain level manually. We have not reached that kind of a artificial intelligence level of maturity that any operational risk event can be automatically captured and reported to the database. So it is definitely, that means it is a important incumbent of the operational risk department to sensitize the branch level people that what is the requirement for recording operational risk event and what are the controls. We'll come to those things later. So this is the data aggregations, then measuring the risk vision, goal, dedicated kind of a business line staffs, constantly repeating, implement training. These are all the standard things which you do for maturity. The final thing is that what is important is this, that operational risk event, what is operational risk event and differences the boundary between an operational risk event and a credit risk event, sometimes not necessarily very pronounced. It can be blurred. For examples, if your underwriting has been done badly, okay, it's a people failure. So it is a particular loan has become the NPA. And when you try to recover these things, you see that proper insurance was not taken, or the insurance was taken faulty, or the collaterals was taken which are not recently have a proper value or market value, or it is not even the mortgage has not been registered. Suppose you are giving housing loan, your housing mortgage not registered properly. So it is a operational risk failure, but this is also credit risk failure. The persons which have given loan, obviously he is as kind of a defaulted willfully. So you could not recover your whatever the loans have been given, you cannot recover the value because your operational risk failure, your legal documents are not very good. There is a lot of defaults and a lot of discrepancies or a lot of kind of errors are there, and which is not enforceable legally very quickly. So this is operational risk event because you could have recovered a large amount of your credit which has gone bad, but you could not do this because you did not have a due diligence in the kind of a materials or the collaterals or the kind of a legal documents you have to create. You did not do it properly. So it is not necessarily that operational risk and credit risk are there. So you require a holistic view of these things, and you have an integrated risk management process. You must have credit risk, market risk. When your operational risk happen or credit risk happen, you must also understand why is there any operational failure? Why a particular level of a particular product in a particular region is becoming much more NPA? Is it because of only the credit default because of the external events, or there is a certain kind of difficult deficiency in your underwriting process, certain kind of a deficiency in your legal kind of a process? All these things are operational risk must be considered. So unless you take this integrated approach for credit risk, operational risk, or market risk also, the dealing kind of a rule, there could be, if you see that lot of kind of a operational risk event happen originated in dealing room, negligence, this SOCGEN, all these things. So what is the difficulty? What is the operational risk failure apart from the other thing? So this is very important for us. Now, if you see the sources of operational risk, which has been studied are there, and one of the study, it is a little bit of earlier study, but it's the way that external fraud and your execution, delivery, and process management, business disruption, system failure. You can see that what are the percentages there in this thing. And the I think the external fraud. 1 minute, yes. Okay. So this is a kind of a data which you have there for sources of operational risk. Okay. Then importance of drivers of the results. Okay. How do you really control the operational risk? What kind of things? These are surveys has done one back, and this is what the improving performance, reducing operational losses. These are the important driver for the operational risk kind of management practices. Now let us go to the operational risk management framework. What is this performance measure? First is a strategy. Does this you have in your bank a operational risk framework properly kind of laid down, where you know that what is the risk, how do you identify, how do you assess it, how do you monitor it, and how do you measure it? So there is a strategy, there is a business initiative, and there's a reporting. Now, there are three components of the operational risk, which is very important for us to understand, apart from calculating the capital for this. One is that RCSA, risk controlled self-assessment. Second is key indicators. Third is loss data. The risk control and self-assessment process is very, very critical to a bank which is interested to a higher level of operational risk management, because operational risk has to be, it is very important that we try to identify before the event happens. Because if a particular kind of a control is there, if the control is assessed not very functioning well, if I do not do this assessment in time and take the corrective action, then you are actually waiting for the operational risk event to happen. If it does not happen, maybe the people are not so smart enough to take the opportunity of that. But it is really important for us that we have this RCSA process, this controlled self-assessment process. That means risk is identified in a process. So if you have, say, loan disbursal process or a onboarding a customer, and then what are the KYC has to be processed, where I can go wrong, I have to then, if I can go wrong, what should be my control process? If there is a control, what should be my kind of a assessment thing? Who is the control owner? And what all these are part of RCSA process. It is extremely important for the operations management framework, and the bank has to look into this very carefully. Then they call key risk indicator. We'll go to details of key risk indicator. That means it is not the event has happened, but is there any kind of a early warning system can be generated where you can say that a risk is waiting to happen in this particular vertical or this particular area or in particular branch? Can we create some kind of early warning system? And then question is that what kind of early warning system? We'll go into that. And third is loss data. Loss data is, of course, it has already happened. If it has already happened, I want to investigate. I want to find out what went wrong. Then I would like to know that if this is the kind of a loss is likely to happen, how much capital I have to keep it for. And that has been given the guidelines by the regulator. So loss data is basically to understand what has happened. Can I investigate that, kind of find out the source of my operational risk causes and what can be done. Apart from that, this is required for your capital computation. Why this is required for capital computations? Because many sophisticated internationally active banks claimed before your financial crisis of 2007-8 that we have a very, very high level of largely automated and process to control my operational risk. So I should not be, penalized for becoming large, because the regulatory capital computations not based on the loss data, were basically connected to some way your what you call the volume of business. The basic idea is that if your volume of business goes up, then most likely your losses also, if percentage remains still, your absolute amount of losses will go up. If the absolute amount of losses go up, so if you have a X and after 5 years you have a 5X your business, then your operational risk capital also must be 5Y kind of thing, Y to 5Y. So basic idea is that as your volume goes on, scale goes up, your operational risk event, even if repeats as an incidence, the percentage of your total volume remains same, it absolute amount goes up. So absolute amount of capital must also go up in tandem with your volume business going. But what happened that many of the internationally active sophisticated banks claim that we have a much more sophisticated process to identify where things can go wrong. Then why should I be penalized for becoming more efficient and becoming more bigger over time? So this is the kind of things is required. So that is why what we call the advanced measurement approach has come. We'll discuss this based on the loss data. Am I in this? Yeah? 1 minute. So operations implementation in bank. So this is a kind of a, I am just giving you one kind of examples here. It is a Unicredit group, a large international banking group providing full range of banking services. And this was created by a consultant who was employed by the bank to evaluate the operational risk management framework or the practices within the bank. And this was you see that what are the kind of observations he made, that no methodologies, no benchmarking approach, no experienced operations manager. Okay, see, point is that no experienced operations manager, you cannot have today, somebody is a general manager in charge of the, say, for example, say your dealing room or your treasury. Suddenly you put him there tomorrow as operations manager. That will not work. You have to have it properly. It's not that you cannot become a good operations manager, but not in a one day. He has to be trained. He has to be exposed to the operational rich kind of principles, techniques, processes, and then can take it work. So no experienced operations manager. There's a lot of kind of if they could see that lot of kind of this operations manager post was not very high flying process. It was a kind of a site posting. So the people who are not so interested, they were just waiting for the kind of a parking their lot and to be shifted to somewhere else. So there's no experienced operations manager was there, no common understanding of how to set up the control process. And this is true because what happened that operations department was not very well organized as a kind of professionally. So no literature, all these things are there, you can see that. So first is that incidents operations are much more the events, result, and losses. And loss, when you go to these losses, see, losses do not immediately, you become visible to the top management unless it is actually reflected in your account book. Okay, when actually our losses is realized, it is accounted for, put in the kind of your profit and loss account book, then only it has to come to the radar of the top management. So there is a lot of way, if the operational risk management at the lower level want to hide these things, they can delay it. Okay, it has happened many times in India that you see that suddenly a person is there in a particular rural branch, relatively large, lot of kind of a small loans have been given, he is meeting the all kinds of prudential norms or all kinds of government schemes targets. And when he leaves after that, you see that there is a lot of kind of failures. And when you investigate that, you see a lot of kind of shortcuts were taken. So these are the things that these realizations or incidents reporting these things need not happen simultaneously as soon as the incidents occurring. When an underwriting has been bad, the failure has been reported, and then actually your recording this in your balance sheets may take time. So this kind of a 1 minute. How do I put it here? Suresha.
Yes, Dr. Mark.
Yeah, I just wanted to, there's a right-hand side, something is there. I wanted to shorten it. How do I do it? It is coming, all the practice name, all the thing. I thought, yeah, okay, I've done it.
Yeah.
So this is the creating a calculation data sets, the policy for recording loss data, which first thing is that what should be threshold? I do not want to have a loss of a 100 rupees or $500 or $200 or $300 loss for some reasons or other. Okay, I have to have a threshold. Okay, and losses below the threshold is generally should be reported in aggregate fashions. Okay, so in any case, suppose a particular bank in India or in suppose anywhere else, equivalent of say $2,500 or $5,000 is the threshold below which I don't want to each event to minutely see the details. I just want to know this is the total losses of this kind of events, what is the number, and some broad characteristics. So which loss an event recorded in the interest loss event database also to be included in calculation data sets. So what will happen when I am calculation data set means I am trying to create a kind of a distribution of losses, these kind of losses which are to be at calculation is important. Then what is the loss threshold? What external data with what scaling should be included in the calculation database? This is an important aspect. Suppose you are starting a new area of business. Suppose you have not done trade finance or the financing of the large exports or something. For now you want to branch out in that. Now, when you are branching out these things, you do not have any obviously activity for any past. So where is your loss data? There is no question of having any loss data. So what the operational risk practitioners has really suggested that there should be an integrations of this operational risk and event of your and outsider. That means there are many banks which are taking this business, which I am entering today. Now their experience of last 5 years or 10 years in terms of the losses in this particular kind of vertical, can I take it into this? And how do I integrate this? So in my case, I have maybe a $5 billion or $10 billion, $100 billion company. Somebody has a say 1,000 billions kind of thing, $1 trillion. So there obviously the data set, if I am to integrate with my kind of a business, I have to scale it properly. So how do I scale it? These are the issues you have to get when you are combining external data, because generally operational risk data is not so frequent, so kind of a large data set is there, which you will get in the kind of credit risk kind of thing, where you can calculate probability of default by cohort method or something. So it is very important that can I enrich my database with experiences of other banks in the same jurisdiction, same suppose a country who are doing similar business. Can I take their experience? How do I combine this? It's an important issue. Then include all relevant insurance data, because ultimately it is not only loss. After loss, what recovery I can make, that is important part. Because when I as a banker do business, obviously I have to be prepared to accept certain losses, because I am as a banker, I'm an intermediary. I am actually what I'm doing risk intermediation. Risk averse depositors and risk taking entrepreneurs. I am the middle. I am doing the risk intermediation. So I am taking risk. But what is the insurance I'm going to take for operational risk? If that is a kind of failure of my systems, okay, what kind of insurance I'm taking? Is it we have to take a prudent decisions, because you cannot have 100% value insurance. It will be very costly. How much you take it? Training to be provided to line managers on data classifications. Decision point, how to reconcile internal MIS with Basel classification system. We have got Basel has classified various kind of vertical business into certain kind of a coherent groups, because we feel that, or Basel has felt that based on their study of the operational risk given across the globe, that these are the kind of verticals should be combined together, because they are subject to similar kind of a process people or the system failure. So that is why I can say that they belong to a homogeneous group of the events which can be modeled as a kind of a loss data set. So decision how to reconcile internal MIS with Basel systems, how to attribute volume indicator of activity, all these things are there for your calculating data sets. So what is the attributes of calculation data set? What are the attributes I have to calculate? These are the examples are there. Now, let me tell you that these examples are based on certain experiences. And there is no, certain things are universal, certain things are specific to a particular jurisdiction. Everybody has to take their own decisions about the calculation data sets. Taking the international best practices, obviously you have to see that it is important for us, but you have to bring your own jurisdictions. What are the critical things are there, you must bring in the calculation data set or not. So this is the calculation data sets. You can see that what are the things are there. Okay. So this is the loss data you are collecting. We'll see that how does one calculate loss data. That is will come later. Second part is that key risk indicator approach is extremely important for the operational risk management, because what is important for us to not to only have the operational risk event to occur. Is it possible to large extent? Is it possible to see that we can reduce the probability of happening an operational risk event in a particular particle by looking at certain early warning system? And this early warning systems is called key risk indicator. So basically, based on the data which can come from the automated way from your core banking system, and based on the data which has to be manually inputted to the system, we can create various kind of key risk indicators. So key risk indicators specific quantitative measures of performance to provide an early warning of potential future losses. Measures that attempt to identify potential losses before they happen and raise red flags if they go beyond range. See, for examples, let us give some examples of the key risk indicators. For example, suppose I am looking at the Treasury Office. Now, if I find that the number of deals are increasing a much faster rate as compared to the number of people are there, so we can always see that this particular indicator where the I am the per capita, where is the number of deals per capita deals are there, or the distribution of the volumes across these things. Can I create a key indicator? Because there is a possibility, a more than even possibility, that something may happen in the transactions recording, transactions kind of other kind of events can happen. So this is a key risk indicator. One of the key risk indicator which is very important which has been found across the world is a very important causal factor for operational risk is to not to rotate people who are dealing with money on a regular basis. This is absolutely important and everywhere. In fact, it is not only in the case of what we take the Society General, which is a very sophisticated bank, but even for a oldest brand in manual processes, which had happened. I can give you a very funny example, of course. See, there was a time in one of the in a rural, not rural, a kind of not a very metro cities, there was a branch where there was a tailor who used to run a parallel bank within the bank. What he used to do, this is a lot of kind of illiterate people were there. They were opening the bank account. So they have a passbooks, okay? And that time passbooks were written in hand, okay? So the person comes and he deposits 1,000 rupees. He will have his own bank in the record of this particular gullible people. He used to run a bank. So he will be writing there his own ledger that he has given 1,000 rupees. His account will be updated in his own ledger, but he will not write the thing in passbook, but it will not be written in the bank's ledger. But nobody even detected that. Why? Everybody who wants to withdraw money, if he is a person who is in this bank's not ledger, but the particular person's ledger, he will give the money back to him. If you have a 10,000 rupees balance, 5,000 you want to withdraw, he will get 5,000. So nobody detected anything. Now, once he was not there, he was taken a leave or anything. Immediately the next person came and obviously everything unraveled. So important you see that it has happened in a manual case, it happened in society general case also. The person who was there, he never took leave. And this was a very important source of the entire event which has unraveled later on. So point is that this is a kind of key risk indicator that how many people in a kind of identified a risk sensitive kind of a desk, how many people are there who are there more than 3 years or 4 years, 5 years, bank can decide by themselves in the same seat. Who are the people who have never taken a leave for last 3 years? In fact, there are kind of banks who forces people to give on a leave for 1 year, at least say 15 days in a year, forces them. It is a mandatory for them. These are the practices have emerged because of this kind of experiences. So key risk indicator can be created. One key risk indicator we created for a bank in India is that it is a key risk indicator which is automatically generated at every branch level. That means that every branch where the home loan were extended to the borrowers, how many home loans within the first year of the disbursement became an NPA, non-performing assets. That means there are some 1 or 2 failures of the EMI. And that will be the number of failures divided by total number of the home loans given by that branch. That becomes a key risk indicator, and that is not created by any manually. It is automatically generated and can come. So it is employee turnover. You can see the various kind of the key risk indicator can be created. So this is the important part of the key risk indicator, that some of them are manually created, some of them created a kind of a automated way. Now, key risk indicator, there are 2 things there. One is the lack KRIs and then the lead KRIs. Lack KRIs means highlight areas where the controls are weak, where something is spent. When things have already, we can see that. But where is the forward-looking key indicators? Forward-looking indicators that nothing has happened so far, but high transaction volumes by the number of employees ratio, that could be the future, it can happen, forward-looking. So you can take immediate kind of action there. So this is because in earlier indicator where loss has happened, NPA has become, and that's why you're finding, and then we're trying to find out that why this particular branch or something, it has become a higher NPA in the first year EMI, then we can investigate. But in this second part of it, lead KRI, high transaction volumes by the number of employees, it's a future, it may happen. That is why you call it forward-looking indicator. So there could be both the things that there. Lack KRIs is to really, lack KRI is only for the identifications of the causes, what actually made these losses happen. Forward-looking is there to take actions so that it doesn't happen in future. So KRIs, there are 2 attributes of their main attributes: risk driver and exposure indicator. What is risk driver? Risk driver is this: what is a potential risk? Now we have defined number of the loans which became NPA in first year, that is the risk driver. But we have to normalize them, because you cannot compare a 100 persons branch and a 10-person branch, 10 employees branch and 100 employees branch of the similar kind of a NPA or similar kind of things. So to normalize this, we have an exposure indicator. So in this case, total exposure indicator is that how many loans were disbursed during that particular quarter, during the particular period, and how many of them became the NPA. So this is the numerator is your risk driver and denominator is your exposure indicator. Then threshold. Do you want that all KRIs, everything is happened, that you have to report that you have to decide that. Then how frequently you should monitor it? That all KRIs need not be monitored on a kind of monthly basis or in a 6-monthly basis, something maybe annual basis. So see, number of employees and your volumes of the business, this is not a monthly basis. You cannot take any action. Only when you compare with the past, over the yearly changes, then it makes a sense for operations manager to raise a flag. So something you have to do it for a yearly basis. And one of the most important thing is KRI is here. The actual level of KRI is not important for an operations manager. What is the number? This risk driver by exposure indicator, the ratio. the level of the ratio as on today is less important than compare how the trend has happened. Is it increasing or not? If it's staying at the same level or not. Increasing trend in the KRI, if it is a kind of a indicator, is a serious issue, and that requires attention of the operational risk management department and the various kind of hierarchy which is there. Then dimension of monitoring, what you want to do? You want to have branch level, or you have a product level, you can have business line level. These are the issues has to be decided by the bank itself based on their business model, on their business where it is concentrated, where you are interested to control your occurrence of the operational risk events. It's important. No, there is no kind of a rules and things can be given.
So
hello.
Would be, considering the importance of this topic, we intend to extend this by another 15 minutes. Hope it is okay for all of you. Go ahead, Dr. Man.
Okay. So this is points. Then alert level on violations of different benchmarks, where the alert should go. How could see if you have a kind of a operational risk, the KRI issues in a very sensitive kind of a area. Okay. For examples where regulations are there, prudential norms are there, and you feel that this KRI is indicating that we are going to a breach of the prudential norms, or regulatory concerns will come, and every bank does not want to take issues with us, does not want to be the wrong side of the regulator. They would do. So they would like to for examples, internal frauds happening there. Internal frauds which are happening in any bank in India, there is a specific kind of a report which has to go to the central bank of the country, that is the Bank of India. So this issue is that now if internal fraud has happened suddenly in certain areas suddenly, and that kind of things must receive the attention of the top management, even the CEO level. So that alert level has to go. That generally in many banks, any internal fraud of a certain amount, of course, not everything, but suppose certain amount threshold, if happens, if it's recorded or reported to any department thing, immediately they would like a report to go to your managing director as chairman of the bank. That is always already followed many Indian banks, that at above certain level of internal fraud, the report must go to the desk of the CEO or the MD of the RI. So then user is responsible for entering data. Some carry data has to be given manually, of course. And that manual data, who is authorized to give this and who is the persons involved, must have the kind of a responsibility has to be allocated, responsibility to be managed. Examples of lead and late cases, you can see that department is that check process is that check clearances, lack risk indicator, number of fraudulent checks cleared per month. That means checks has been brought in and that without the balance is not there, signature did not, so many things. So this is a lag risk indicator. Now, why this is a key risk indicator? That if it is happening in a particular branch, a particular area where it is increasing, or it is compared to its peer groups of this branch in other areas of similar size, it is much higher. That can be definitely a source of concern that can be flagged and that can be created. Secondly, lead key risk indicator, that is need for investigation. You see the number of fraudulent checks, if it is a tolerance level goes up, then you have to do these things. Lead key risk indicator examples: branch, teller, cash disbursal, number of customer transaction per day. So it is warning, if a teller earlier he was handling say 100 cash disbursal in a day, today he is being forced to have a 200 because of the pressure dealing, and there is no additional manpower has been allocated either by the branch or the controlling office, then it's a warning signal. So this kind of a indicator, see, point is that operational people, those who are actually running the operations, the branch manager or his controlling office manager, may not be interested to immediately put another kind of a resources, because it eats into the profitability of that particular branch or particular kind of a hierarchy in a region. So they will be trying to delay this, but it is the job of the operations department to create this warning signal, okay? Because it is something you are an outlier as compared to the peer group kind of day. Then it is the duty of the operations manager to highlight it. And generally, operations department will report to the directly as a chief risk officer or something. Then it can be brought into it. So this is a nothing has happened. It is not that it is going to, but it can happen. So it is a late case indicator. Next part is what we call the risk and control self-assessment framework. What is a self-assessment approach? Self-assessment approach basically means there is a control owner, and this control owner assessing himself what is the health or the sanity of the control as existing today. For example, how do one identify risk and control? That is a different issue that will come later on. There's a big process is there. But suppose we have identified, for example, I have ATMs which are associated, many ATMs are there which are connected to the branch. Just outside the branch, the ATMs counter is there, sometimes within branch. Now these ATMs, if it is there connected to branch or it is under the control of a branch, the branch manager is the controlling authority of that particular hardware or ATM and the process of the involved there. Now, what is the control? What the point is that what is the risk is there? Risk, one of the risks is that there could be a kind of a hacking in or it could be some kind of a dacoity or many kind of things. People take money out of the ATMs in fraudulently for many processes there. Now, what is the control there? Theft can happen, dacoity can happen. It's not, you are not the police, but there could be guards also, but that still can happen. One of the control is that you have is what you call a properly functioning your closed circuit TV, CCTV. Why it is a control? Because even if things happen, it is the control of this particular CCTV will help you to nab the people who have done it and try to recover the things, at least some process can start it. So this is the control you have to look at it. And who is the control owner? Control owner is the branch manager. And what is the control owner has to self-assess that maybe in every 3 months or every 2 months, he has to assess that it is functioning. He can see that all the recording is legible, it is working fine. So that means that is an important control. People know that this is CCTV is there, it is fine. Then people will be less prone or less interested to do any kind of a purging. So this is a control owner. He is self-assessing the control health, that it is working fine, there is no issue is there, and it is doing its job very quickly. So this is called self-assessment approach. And now question is that what is the role of the operational risk department here? The operational risk management framework should say that which control, what is the role of the control? Is it a preventive control? Is it a curative control? There are certain kind of controls are there. And what frequency it should be assessed? What should be the questionnaire? Who will do the assessment? Who is authorized to do the assessment? And how frequently he should report the assessment through a questionnaire. So generally risk control self-assessment process is, how does it start? You identify all processes, what kind of risk can happen. Okay, for example, you are doing a onboarding of a customer and you have a KYC norms, many important things, the KYC norms are handled properly. Now, one of the control of the KYC norms is that, you should send a thank you letter to the address where it is given by these things, and see that in a kind of either by a registered post, so that there is a kind of record is that if it is not delivered because not found in the address, the name, it's a very important control, because it should immediately flag a thing that there must be something fishy about this particular customer who has given us everything, Aadhaar card, everything, was giving a false address. Of course, it is a KYC kind of breach kind of thing, and immediate kind of investigation should be there. Now, if you do not have it, give it to you. Okay, this control can fail. Okay, and that happens there. And there are a lot of incidents are there when this is a one control failure has led to losses. Lot of examples are there. In fact, you can, I don't want to have time, but you can give a lot of kind of examples are there where substantial kind of a operational risk losses bank has incurred due to this onboarding process of KYC failure. In fact, today, there are a lot of kind of processes are outsourced by the banks to the outside vendors. Now, what kind of controls you are having there is very important. So the process of generally perceived as effective since it is performed by the people of the unit who know the business best, assigns risk management responsibility people in the line, provides effective aggregation approach. This is the RCSA process important. And it is extremely important for operations. Apart from the, see what I have seen that many banks, they are more interested to how they call capital, how they compute capital, whether computation capital, and then you have a sufficient capital kept in your equity. That is the end of the operations management. This is the not any way the best practices in operations management. Capital will be there to absorb losses, but it is your job to do that. Losses do not happen, and losses will not be, incidence of loss will be much less if you have this KRIs, if you have the RCSA process indeed. And even in India, I can tell you that RCSA process is very, very rudimentarily practiced in most of the banks. So RCSA approach, first approach is that map organization structure. You see this. Identify and map critical processes. Okay. Which are the critical processes where if losses happen, we can have become a brief loss, and that you have to happen. Then create risk control maps. That means you identify process, within process, identify the risk. That means all the tasks, you break it down the process. Every task, what can go wrong, you have to identify. And what can go wrong, like we told that is a wrong is the address is going wrong. Then what is the control for that? Control is that you give a thank you letter. If it is a not delivered, returned is that is means that there is a something is wrong with that. Then there could be scorecard implementations that the controls is there. How they combine your control assessment process to a single kind of that is the overall health in a branch. The controls which are there for the branch manager. How many, there could be number of controls. Can I really aggregations? Because if you take too many details and if you don't have aggregate picture, you cannot take a broad actions at a higher level. So you must understand that what is the level of controls which are there in a particular vertical or business lines on a product and where the failures are happening. So that is a scorecard implementation that how can I give a scores kind of things. Some way of aggregations should be happen. These are all matter of details we cannot discuss immediately there, but it should happen. And assess risk control measures, make control decisions that if it is not done, that why the control has failed. Okay, suppose the risk assessment is done and control assessment says that it is not working the ECB for 3 months. What you have done? He says that I have sent a letter to the some department, procurement department, some departments, IT department, or whatever the departments are there, and it is lying there. Why it is happening? So until unless there is a proactive kind of a follow-up of these things, so make control decisions that how do we do these things. This is a RCSA implementation approach. The tricks of the matter item is that identify what can go wrong, where it can go wrong, identify what control you can have to prevent the occurrence of event to the maximum extent possible. It is impossible to say that nothing will happen, but at least you should try to reduce its incidence. So this is the second part of it talking. That is second and third, and that is where the bank's internal maturity in the implementation of the operational risk is more important. So RCSA, you have got the same thing. Whatever I've told you, it is exactly same things. And then what are control transfer? Can I see, for example, something may go wrong? You have IT assets. Some IT assets, some kind of a network can fail. If network fails, how many hours it can fail? The people are not able to access their account when you visit the branch. What can be done? What can they transfer? Can I say that immediately? Can I say that next another branch, I can have a process that they can go there, do the same thing and not? Then how do I avoid and how do I control? These are the three things has to be there. And second thing is important that step 2, that certain risks we are agree to them. See, you cannot have that all borrowers will be standard assets and nobody will fail. That will fail. It is not possible that you always have the best possible, the most highest net kind of a job which you have. I'll give the home loan. I'll not give something there. You have to take risk. As a banker, it is our job to take risk. But question is that, am I taking the potential risk? And if I'm taking the risk, is there any way I can control the risk to the maximum as possible? That is the most important things. So that's why I call accepted risk and unaccepted risk. Which are the risk you are taking, which is unaccepted, you cannot take. So for example, investment department, if you're investment department, that is a control could be. There are dealers who are taking the kind of a exposure to a particular kind of a security which are very risky. And if a dealer is making a huge kind of profit, that it should be a kind of a KRI. That is it because he's taking too much risk. Okay. So then we have a color getting this control. You have to see that controls. Can I do it? Once I do this kind of things, then I can aggregate it in some way and make a overall structure that what is the control process at a branch level, aggregate to this a kind of a region level, zone level, or maybe a higher level. Then you have got this kind of risk matrix to be created. After we have this, all these processes, we create a risk matrix. We can create risk matrix for the business unit level, okay? Or you can create that at the product level, that is products which are the kind of a very high risk, catastrophic risks, or these things are happening. So this is the kind of impact and the probability. Which is the impact? This is a insignificant, minor, but something is catastrophic. Catastrophic could be that your entire kind of a your entire dealing room is suppose suddenly subjected to certain kind of a catastrophic kind of a event, say earthquake or something. What will happen? This kind of things. So these are the things which are there. You have to create risk matrix is a part of these things. So RCSA process, what are the important things is that the control issues must be relevant to business line risk. You cannot just say that I will control everything. It is not there. The controls has to be there, which is relevant to your business kind of a your line and business kind of risk. Which risk you are tracking, knowingly that is a risky things. How do I can control? That is important. Answer choices. The answer choices will be consistent. That means there should be a questionnaire of evaluating the control by the control owner. This questionnaire should be provided to the automatically to the control owners in a well-defined frequency, and well-defined frequency it should be reported to your manager and the higher ups. Then controls must be weighted according to relevance, that which controls are most important. They should get a higher kind of weightage, because ultimately it is job of us to have a one single kind of scores of the controls efficiency at a particular business unit level. And then it is, these are all normalization, validations, all these things are the standard process which had been done here. I think that is nothing much is there to talk about.
So Dr. Nag, you may want to touch upon the approach, Basel approach. And
we'll go there now.
We need time for Q&A also.
Okay, now the question comes that, see, this is the approach which has started in Basel 2. That is the basic indicator standardized and internal measurement approach, which is called loss distribution approach. So basic indicator approach philosophy is that more your volume of the business, you have to keep the capital according to, there's some kind of a percentage of given, called alpha 15%, will come there. Standardized approach is that the basic indicator approach is the overall kind of total volume of the business. Basic indicator approach is that total volume is not a correct thing, because volume in a very risky area is growing. It's more important for us to control that risk rather than the not so much risky area your business is growing, because business is not growing identically across all verticals. So you have to have the most riskier kind of a verticals where the more risk events can happen, given a little higher kind of a capital requirement as compared to this standardized approach. Internal measurement approach or these things is the basically loss distribution approach, is that you try to create a loss distributions like a thing. And for example, in a market risk, we find out a security losses is there, what percentile losses can happen because of the market movement. Similarly, here you find out from your past experience, what are the loss kind of distribution is there, and which percentiles, 99.5% or value at risk, you can calculate and get it done. That is called loss distribution approach. So this is what you're talking about, standard visual we have talked about. Let's go one thing. This is the basic indicator approach, and this is the alternative standardized approach. This is the only difference is that loans, advances, retail banking, they are separately and then combined. Okay, I think this is absolutely simple. Basic idea is that you have to measure a certain kind of heuristic for the what is the measure of the volume, what could be generally income or revenue. And if it is income is there, and if a particular business unit, suppose you have a income from the credit and income from the certain kind of a investment, and deposit oriented branch and the credit oriented branch, how will be done? I think these are the issues has to be there and complete. So these issues is your standardized alternative standardized approach. So incomes, when they are combined in a branch, how do I allocate the income? Because there is only one branch, all the people are there. So you have to allocation of income across the verticals is an issue has to be done. And that can be done by looking at the detailed GL code level data.
So Dr. Nag, we have to give time for one or two questions.
Yeah.
We can summarize.
Yeah. So now your loss distribution approach are rolling up. This is absolutely you take the loss data, try to figure it out. How do I make a kind of distribution of the loss data? And then this is a kind of a broadly loss distribution. Basic is that it is a summary of the, there are two things at the loss distribution you must understand. One is called frequency of losses and severity losses. And these two are to be treated separately. It's not that all losses are there only, and then you have to have frequency, particular loss, how frequently it happens. And if it happens, what is the level of severity? And you model them separately, and then that is a way of combining these two models, get a proper loss distribution. So this is a statistical kind of approach, and that is being one of the things is there. Okay, this is guidance management approach. I think I'll close it here, because after that, more of a technical kind of things, not necessarily, business decisions are required for this. Thank you very much. Can I take call now? Questions?
Yeah. Thanks. First of all, thanks for to all the participants for patiently listening. As you might have already seen and understood, operational risk is one of the areas of great importance to banks, and one can spend a couple of days to cover the length and breadth of this subject. It's always a challenge to summarize all the aspects in a short span of 50 or 60 minutes. And Dr. Nag, you did a wonderful job in covering all the key aspects. Just to conclude, I would like to mention just one or two things. So today, the need for operational risk has assumed much greater importance than what it used to be a couple of years back. So banks have no option today but to have built a strong operational risk framework, and it has to align with the impending Basel IV, which is around the corner. So this is an area of importance, and focus is very much required, and it aligns with your overall risk management vision. Next slide, please. So with these few words, I would like to thank each one of you for joining this webinar and making this successful. And with this, we are concluding our fifth of the webinar in our series of webinars, which we are planning to do over the next 6 months. The next one would be, again, another very interesting session we would like to bring in on regulatory capital landscape. It would be on Thursday, 30th September, same time. And if you have any questions, feel free to reach out to us. And in the interest of time, we would like to, next slide, please. In the interest of time, we would like to take a couple of quick questions. The floor is open for any of the participants, if they have any queries. There is a question how we can get slide after the meeting. Let me take this. We'll be happy to share the link, for the participants. We understand that this is a subject or this is an area which requires deeper insight. We'll be more than happy to share the link. Please leave your email ID. I will note down and ensure that it reaches you. Any other questions, please?
I think we can conclude. Correct.
Yeah. So thanks once again. If you have any questions, just feel free to reach out to us. We'll be more than happy to revert to you. And also in your bank, if you have any challenges around operational risk area, or if you are requiring any consulting support or a product support, just reach out to us. We are here to help you in this important journey. Thanks once again for gracing this occasion. Have a nice day, nice evening, depending on the location where you are. And we look forward to see you again on 30th September, 2 weeks from now, same time. Until then, bye.